Hello viewers, welcome to my channel. I'm Hashim. Last video I have completed problem number 11. Now in this video I'm going to explain you about the 12th problem. So we are doing the problems on admission of a new partner. So what are the adjustments to be made whenever a new partner is admitted in a partnership firm? So already 11 problems I've completed. If you're watching all the videos, then definitely you will get a lot of command on this topic of partnership accounts. So don't join in between or don't leave in between. If you want the perfect knowledge, watch all the videos from beginning till end. So apart from this advanced accounting, I have uploaded so many videos on different subjects of graduation, post-graduation and professional studies like financial management, investment management, statistics for management, management accounting, cost accounting, corporate accounting, financial accounting, income tax, business statistics. So many videos I have uploaded. So visit the playlist of my channel, select your subject, select the videos, watch the video and enhance your knowledge. Get the confidence on the subjects. So before starting 12th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep reading the problems. Without problems, you cannot understand my lecture. So take the screenshot of the points which I have written on the board, then I'll explain. Now, see the 12th problem. Surya and Chandra, sharing profits in the proportion of 3/4 and 1/4, furnished their balance sheet on 31st December 2010 as follows. The two partners are there, Surya and Chandra, and the profit sharing ratio is 3/4 to Surya and 1/4 to Chandra. Now, creditors, general reserve, capital accounts of Surya and Chandra. Cash at bank, bills receivable, debtors, stock, office furniture, land and building. Now remember, whenever a new partner is admitted, so before the admission, the general reserve will be shared by the old partners in the old profit sharing ratio. So now in the new balance sheet after admission, general reserve will not appear. General reserve will show a credit balance. Now we will debit. So debit general reserve and credit old partners capital account in the old profit sharing ratio. They admit Tara into partnership on 1st January 2011 on the following conditions. Tara pays 30,000 as his capital and for 1/5 share in future profits. New partner Tara, she is bringing in 30,000 as her capital and for 1/5 share in future profits. And Tara pays 40,000 as goodwill also. So apart from capital 30,000, the new partner brings in goodwill in the form of cash, 40,000. Remember, this goodwill will also be shared by the old partners in the old profit sharing ratio. The stock and furniture is reduced by 10%. So revaluation account debit, stock account and furniture account credited. Then 5% provision for doubtful debts to be created on debtors. So revaluation account debit, provision for doubtful debts credit. Value of land and building be increased by 20%, appreciate. So land and building account debit, revaluation account credit. The capital account of the partners be readjusted on the basis of their profit sharing ratio and any additional capital to be debited or credited to the current account. This is the new point and critical point. First time we are coming across this point. That means the capital of the old partners should be in the new profit sharing ratio. From the following information, draw the necessary ledger accounts and new balance sheet of the firm. In this problem, we are not required to pass the journal entries. Directly, we have to make the ledger accounts. But before that, the new point in this problem is the capital of the old partners should be adjusted according to new profit sharing ratio, and whatever excess capital or shortage of capital, that will be transferred to the current account of the partners. Earlier current account was not there, But now current account has to be created for the old partners. If any surplus capital or deficit capital is there, that will be adjusted in current account. That is the new point. But before that, first of all, we'll find out what is the new profit sharing ratio and the new capital of the old partners. Old partners' capital should be adjusted according to new profit sharing ratio. The new point in this problem. That means the old partner's capital should be according to the new profit sharing ratio. But new profit sharing ratio is not given. So first we find out the new profit sharing ratio. What is the old ratio of old partners? That is Surya and Chandra. The old partners are Surya and Chandra. Their profit sharing ratio is 3/4, 1/4. 3:1. Now, new partner Tara's share. The new partner Tara's share of profit is 1/5. So, after giving the new partner 1/5 share, the remaining share 4/5. 1 minus 1/5. If you subtract 1/5 from 1, you will get 4/5. So, the remaining 4/5 profit will be shared by old partners Surya and Chandra in the old profit sharing ratio. What is the old profit sharing ratio? 3/4, 1/4. So what is the new ratio? New share of Surya. The remaining profit is 4/5. So 4/5 into what is the old ratio of Surya? 3/4. So 4/5 into 3/4. 4 gets cancelled, 3/5. The new ratio of Surya is 3/5. What is the new ratio of Chandra? The remaining profit 4/5. This will be multiplied by the old ratio. What is the Chandra's old ratio? 1/4. So 4/5 into 1/4. 4 and 4 gets cancelled, 1/5. So we got the new ratio of Surya and Chandra. Surya is 3/5, Chandra is 1/5. Now therefore the new ratio of Surya, Chandra and Tara. Surya is 3/5, Chandra is 1/5 and Tara is also 1/5. So 3/5 is to 1/5 is to 1/5, it comes to 3:1 is to 1. That's it. Now we find out what is the total capital according to the new profit sharing ratio. How much is Tara's capital? 30,000. New partner Tara brings 30,000. For how much share she is bringing 30,000? 1/5 share. Tara's share is 1/5. So for 1/5 share, Tara brings 30,000. 1/5. So complete capital of the new firm will be 30,000 into 5. Because 1/5 comes to 30,000. So 5 times of 30,000 is 1,50,000. The total capital of the new firm after Tara's admission will be 1,50,000. In that 1,50,000, what is the share of Surya? 3/5. So 1,50,000 into 3/5, it comes to 90,000. And Chandra, 1,50,000 into 1/5, it comes to 30,000. So the new capital of all the partners will be Surya's capital should be 90,000, Chandra's capital should be 30,000 and Tara's capital is 30,000. We got the capital. That is the new point in this problem. So immediately you may not be able to understand. So watch the video twice, thrice and keep a notebook, write down important points. Then only you will get the full command. You can enjoy learning the topic. Now, we are required to prepare the ledger accounts. We will open revaluation account, general reserve, goodwill account, bank account. Right? Apart from that, capital account, current account. So first of all, revaluation account to find out whether there is profit or loss on revaluation. So here it is given, the stock and furniture be reduced by 10%. So entry will be revaluation account debit, stock account credit, furniture account credit. So revaluation should be debited. So debit side to stock account to furniture account. How much? 10%. The stock is 40,000. 10% of 40,000, 4,000. Here I have taken. Furniture is 11,000. So 10% of 11,000 is 1100. So here I have taken 1100. Now apart from that, 5% provision for doubtful debts is to be created on debtors. The entry will be revaluation account debit, provision for doubtful debts credit. So 5% of debtors, 16,000. So 5% of 16,800. Here, provision, right? Next comes value of land and building be increased, appreciated. Entry will be land and building account debit, revaluation account credit. So credit side land and building. So 20% of 35,000, it comes to 7,000. Right? We have revalued all the assets and liability. Now any balance that shows the profit or loss on revaluation. If credit side is more, there is a profit. If debit side is more, there is a loss. So here you can see credit side is 7,000. More. So from 7,000 you deduct minus 4,000, minus 1100, minus 800. So balancing figure is 1100. This is the profit. And this profit will be shared by old partners Surya and Chandra in the old profit sharing ratio. The old profit sharing ratio is 3:4. 3 by 4, 1 by 4. So 1100 into 3 by 4, 825 profit. This goes to Surya. And 1100 into 1 by 4, 275. This is the revaluation profit, goes to Chandra. That's all, revaluation account closed. Now general reserve. I told you before the new partner is admitted, any general reserve balance will be shared by old partners in the old profit sharing ratio. The entry will be general reserve account debit to Surya's capital to Chandra's capital. The general reserve account should be debited, the debit side to Surya's capital to Chandra's capital. In which ratio? Old profit sharing ratio. So 8,000 into 3 by 4, you will get 6,000. 8,000 into 1 by 4, you will get 2,000. Now general reserve account is closed. Now it will not come in the balance sheet. Next comes goodwill. The new partner, Tara, brings goodwill in the form of cash, 40,000. The entry will be bank account debit, goodwill account credit. So here I have taken by bank 40,000. Now this goodwill will be shared by the old partners in the old profit sharing ratio. Surya and Chandra, 3 by 4, 1 by 4. So 40,000 into 3 by 4, 30,000. 40,000 into 1 by 4, 10,000. That means goodwill account is closed. It will not appear in the balance sheet. Next comes bank. First of all, what is the opening bank balance given in the balance sheet? Cash at bank 22,500. So I have taken 22,500 to balance brought down. This is the opening balance. Before admission, the bank balance was 22,500. Now Tara is the new partner. She brings capital of 30,000. So entry will be bank account debit, Tara's capital account credit. The bank account debit side, Tara's capital 30,000. Apart from that, Tara brings 40,000 for goodwill also. So entry bank account debit, Tara's goodwill account credit. Bank account debit, goodwill account credit. So goodwill 40,000. That's all. Now you add up all the three amounts, you'll get 92,500. Now balance carried down, balancing figure 92,500 carried down. So brought down 92,500. Now in the new balance sheet, the cash at bank should be taken 92,500. That's all. Now we have to make the capital account and current account. Now see carefully. Partners capital account. S stands for Surya, C stands for Chandra. So before the admission, what is the capital of Surya and Chandra? It is given 60,000 Surya, 32,000 Chandra. So opening balance. So here I have taken by balance brought down 60,000 Surya and 32,000 Chandra. Right? Now apart from that, the goodwill. When goodwill is received and shared by the old partners, the entry will be goodwill account debit, old partners capital account credit. So credit side goodwill, 30,000 to Surya and 10,000 to Chandra. Then general reserve. Already general reserve is shared by the partners. Surya 6,000, Chandra 2,000. So Surya 6,000, Chandra 2,000. Apart from that, profit on revaluation. Profit on revaluation 825 Surya and 275 Chandra. So 825, 275. That's all. Now closing balance. So after the admission, the partner's capital, Surya's capital should be 90,000 and Chandra's capital should be 30,000 after making the adjustment. So in the problem it is given that the old partner's capital should be adjusted according to new profit sharing ratio. So we have already adjusted. Then it is according to the problem, the capital of Surya should be 90,000. So here I have taken 90,000 balance carried down, 90,000 balance brought down. That should be the capital of Surya after admission. Similarly, Chandra's capital should be 30,000, here 30,000, right? Now the balancing figure should be transferred to current account. It is given in the problem. Any excess capital or shortage of capital should be adjusted in current account, that is given in the problem, right? Now take the total on the credit side. Credit side total is 60 plus 30, 90, 96,825. Here also I am taking 96,825. From 96,825 deduct 90,000, remaining is 6,825. This capital, this excess balance, actually his capital should be 90,000, but his capital is showing 96,825. His capital is showing more balance. How much more? 6,825, and this should be transferred to the current account. So debit side to partners current account balancing figure 6825 for Surya. For Chandra, you can see here Chandra 32 plus 10, 42, 43, 44, 44,275. 44,275 is the credit total. Same 44,275 I am taking here. 275, 44,275. 44,275 minus 30,000, 14,275. So 14,275 is the excess amount in the account of Chandra. Actually his capital should be 30,000, but his capital account is showing 44,275. Excess capital. That excess capital 14,275 will be transferred to current account. This 14,275 transferred to current account. This is the balancing figure. Right? It is not given in the problem. We have calculated. Now current account. Earlier there was no current account. Now current account has been opened to adjust excess capital account. Here excess capital account. So entry will be partners capital account debit, partners current account credit. So capital account is debited, current account is credited. So current account by partners capital 6,825, 14,275. Here we have taken. Now simply take the balancing figure, no other adjustment in the current account. Now take the same total 6,825, 14,275 to balance carried down balancing figure by balance brought down 6,825, 14,275. Now this balance will appear in the new balance sheet. That's all. Finally, we have to make the balance sheet. By seeing the old balance sheet, we can make the new balance sheet. Old balance sheet, creditors 37,500. We have not made any changes on creditors. Whatever was there earlier, same will appear in the new balance sheet. So creditor 37,500. General reserve already shared by the old partners. Now it will not come. Then capital accounts. Earlier only two partners were there, Surya and Chandra, 60,000, 32,000. But now three partners are there, Surya, Chandra and Tara. So Surya, Chandra and Tara. And what is the brought down balance capital? Balance brought down 90,000, 30,000, 90, 30. And Tara's capital, new partner Tara has brought 30,000. That's it. Now current account. In the old balance sheet there was no current account, but now we have current account. The current account balances are 6825, 14275. 6825, 14275. Surya and Chandra. Liability side completed. Now I am coming to the asset side, cash at bank. So earlier old balance was 22,500, but we should not take 22,500, we should have to take the current new balance. The bank account here balance is 92,500. Already we have calculated here. To balance brought down 92,500. So this 92,500 I have taken here. Now bills receivable, we have not made any changes on bills receivable. Then 13,000, same 13,000. Debtors, 16,000 are the debtors. But we have made a provision for doubtful debts. Here you can see provision for doubtful debts 800. So this 800 will be deducted from 16,000. So 16,000 minus 800, 15,200. Now stock. Stock was reduced by 10%. So 40,000 minus 4,000, 36,000. Furniture also we have reduced by 10%. Furniture was 11,000. So 11,000 minus 1100. 11,000 minus 1100, 9,900. And lastly, land and building 35,000. And we have increased by 20%. By 7,000 we have increased. Here you can see. By land and building 7,000. Appreciation. So 35 plus 7, 42,000. That's all. We have taken all the items, we have adjusted in everything which is given in the problem. Now find out the total on the liabilities and total on the assets. The liability side total 2,08,600. Asset side total 2,08,600. That's all. Balance sheet tallied. So this is the end of problem number 12. Inshallah, we'll continue the next problem in the next video.